Hello everybody, welcome to my free online forex trading course. And remember, in the last lesson, in the lesson 3, we talk about the history of forex, talk about the market makers, we talk about the various trading sessions that we have, and some other things. Now, we are moving to lesson 4. We're going to talk about how to make money trading forex. How to make money trading forex. We are going to talk about how to read a forex quote, know when to buy or sell a currency pair, margin trading, what is a PEEP in forex. So these are the outlines we are looking at today. So please make sure you watch the video and don't skip, so that you get everything that I'm going to say. Now, if you are new to this channel, please, or this course, please make sure you subscribe to my channel, like the video, and hit the notification button so that when I post another video, you'll be able to get the notification. Now, let's get started. How to make money trading forex. Now, the objective of forex trading is to exchange one currency for another in the expectation that the price will change, so that the currency you bought will increase in value compared to the one you sold. Now, look at this trader's action. Let's say you want to buy the euro US dollars. Euro US dollar. You are buying the euro US dollars. You are expecting that the euro will get stronger while the US dollars will get weaker. That's your expectation because you are buying the euro US dollar pairs. Now, let's say you purchase 10,000 euros. Now, look at it. At this exchange rate, 1.1800. That's the exchange rate that you purchased it. Then 2 weeks later, okay, let's see. So when you multiply 10,000 euros times 1.1800, you get 11,800. That's what you get. Then let's now say 2 weeks later, you exchange your 10,000 euros back into US dollars. You know, in forex, when you buy, you are expecting to sell back. There are two transactions. When you click on buy, you expect the price to go up, then you sell back. So now when you are selling it back, 2 weeks later, you exchange your 10,000 euros back into the US dollar at the exchange rate of 1.2500. When you bought, it was 1.1800, but now it's now 1.2500, meaning you have made profit. So by the time you multiply it with 10,000 euros, you get 12,500. So the difference between 12,500 and 11,800 is what? 700. So meaning you have made $700 profit. You have made $700 profit. But assuming when you purchased at the exchange rate of 1.1800, the price now went down to like maybe 1.1700. That means you have made a loss of $100. So that is how to make money in forex. And if you want to sell too, it's the same way. If you want to sell, let's say you are selling the euro US dollars. What are you doing there? When you sell euro US dollars, you are expecting euro to weaken, while the US dollars strengthens. You expect the US dollar to get strong while the euro gets weak. So in that case, you are expecting the price to go down. You are expecting the exchange rate to go down. So after it has gone down, then you now buy. You buy it back and make profit. That is how to make money in Forex. So let's go to the next outline. How to read a Forex quote. How to read a Forex quote. Currencies are always quoted in pairs, such as GBP/US dollars, GBP/USD, or USD/JPY. The reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. That's what I explained earlier. When you click on buy, let's take for example GBP USD. If you click on buy, you are buying GBP and you are selling USD. That is it. If you click on sell, you are selling GBP and you are buying USD. That's just the logic behind it. Now, here is an example of a foreign exchange rate for the British pound versus the US dollars. Look at the example here. See the example. Great Britain pounds / US dollars. Look at, let's assume this is the rate. This is the exchange rate, 1.51258. Now, that first currency is the base currency. We call it the base currency. While the second currency is the quote currency. The first listed currency to the left of the slash is known as the base currency, while the second one on the right is called the counter or quote currencies. When buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. Now, okay, let's say you want to exchange. You want to buy the Great Britain's pounds. You want to buy it. This is the exchange rate. This is the amount you are going to buy it in exchange for the US dollars. What does it mean? It means for you to get one Great Britain pounds, you need $1.51258 to get 1 Great Britain pound. That's what it means. Let me take it again. It means for you to get 1 Great Britain pound, you need $1.51258 to get it. That's just what it means. So that's what base currency and quote currency means. It is the quote currencies that is written that as the rate. So when buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. In the example above, you have to pay 1.51258 US dollars to buy 1 British pound. That's what I explained earlier. So you need 1.51258 to get 1 British pound. That's it. Very simple. Now let's go to the bid/ask. What do we understand by bid in Forex? What do we understand by ask? Now, all Forex codes are quoted with 2 prices: the bid and the ask. So we have the bid price, we have the ask price. For the most part, the bid is lower than the ask price. What they are saying here is that Forex codes are always in twos: the bid price and the ask price. The lower one is the bid price, while the higher one is the ask price. Let me show you something. You can see this GBP CHF. That's Great Britain pounds, Swiss franc. This first one is the bid price, 1.25495. That's the bid price. While the higher one is 1.25650 is the ask price. Shall come back here. Now, the bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means the bid is the best available price at which you, as you, the trader, will sell to the market. The ask is the price at which your broker will sell the base currency in exchange for the quote currency. This means the ask price is the best available price at which you will buy from the market. Another word for ask is the offer price. Now, the difference between the bid and the ask price is popularly known as the spread. The spread. In my last video, I mentioned spread. So, spread is the difference between the bid price and the ask price. Let me show you again. Look at this. You can see GBP CHF. The bid price 1.25495. The ask price 1.25650. So when you deduct when you find the difference, so if you deduct 1.25495 from 1.25650, what you get is the spread. You can see it's even written here. This broker wrote it. Spread 155. That is the spread. Look at the second one, USD CHF. The spread 40. Look at gold. Spread 60. And so on. You know when to buy or sell a currency pair. There is a time to buy and there is a time to sell. You don't just buy anytime. Or you don't just open your code or your trading platform and just click on buy or click on sell anytime. There is a time to buy and there is a time to sell. In this example, the euro, now let's take a look at the euro US dollars. I want to take a look at the euro / US dollars. In this example, the euro is the base currency because it's the one written first. The one written first is the base currency, while the second one is the code currency. And thus the basis for the buy / sell. If you believe that the US economy will continue to weaken, which is bad for the US dollars, you will execute a buy euro / US dollar order. As you believe that the US economy will go bad. So what will you do? What will you buy? You buy euro US dollars. What does that mean? You expect the euro to get stronger and expect the US dollars to get weaker. That's what this means. So by doing so, you have bought euros in the expectation that they will rise versus the US dollars. If you believe that the US economy is strong and the euro will weaken against the US dollars, you would execute a sell euro / US dollars order. It's the same way. If you believe the euro will become weaker, you sell it. So that means the US dollar will get stronger. So you sell that pair. By doing so, you have sold euros in the expectation that they will fall versus the US dollars. Now, next one now is the margin trading. Margin trading. When we say margin trading, what do we mean? Say margin trading is simply the term used for trading with borrowed capital. As borrowed capital. This is how you are able to open $1,250 or $50,000 position with as little as $25 or $1,000. Why? Because of the margin trading. You can conduct relatively large transactions very quickly and cheaply with a small amount of initial capital as a result of the margin trading. Take for example, you believe that signals in the market are indicating that the British pound will go up against the US dollars. So you open one standard lot, which is 100,000 units, GBP / USD. Buying with the British pounds at 2% margin and wait for the exchange rate to climb. When you buy one lot, that's 100,000 units of GBP US dollars at a price of 1.50000, you are buying 100,000 pounds, which is worth 150,000 US dollars. 100,000 units of GBP multiplied by 1.50000. If the margin requirement was 2%, then you have 3,000 US dollars. That's 2% times 150,000 US dollars. You get 3,000 US dollars. So then $3,000 will be set aside in your account to open up the trade. That's 150,000 US dollars times 2%. So you now control 100,000 pounds with just 3,000 US dollars. You now control 100,000 pounds with just 3,000 US dollars. So we'll be discussing margin more in depth later, but hopefully you are able to get a basic idea of how it works. So we'll discuss it more later. Now, the third one, your prediction comes true and you decide to sell. You close the position at 1.50500. You earn about $500 because your expectation came true. So you earn $500. Now, next one, rollover. What do we mean by rollover? For positions open at your broker's cutoff time, usually 5 p.m. EST, there's a daily rollover interest rate that a trader either pays or earns depending on your established margin and position in the market. If you do not want to earn or pay interest on your positions, simply make sure they are all closed before 5 p.m. EST, the established end of the market day. When do you pay this? You pay when you leave your trade on to the next day. That's to the next day. More than 24 hours. Let me just say that. So that's when you pay that. And as you leave it, the long-term traders, you know what I'm talking about. So if you are a long-term trader, you leave your trade for days. So those interests will be accumulating. They are not much, but as you make profits, you make it in multiple folds. So since every currency trade involves borrowing one currency to buy another, interest rollover charges are part of Forex trading. That's it. Interest is paid on the currency that is borrowed and earned on the one that is bought. Do you get that? Interest is paid on the currency that is borrowed, the one you borrowed, and you earn interest on the one that is bought. That's it. Now, the next outline. What is PEEP in Forex? What is PEEP? What do we call PEEP? The unit of measurement to express the change in value between the two currencies is called a PEEP. Now, let me explain this. Let's say a move from 1.2250 to 1.2251. No, it has moved by what? 1. So that is what? It has moved by 0.001. sorry, 0.0001 rise in value. That is 1 PEEP. That's 1 PEEP. So a PEEP is usually the last decimal place of a quotation. Most pairs go out to 4 decimal places. So a PEEP is the 4th decimal place. That's what you use to calculate it. So the difference in movement is the PEEP, whether upward or downward. So most pairs go out to 4 decimal places, but there are some exceptions like Japanese yen. Japanese yen pairs, any pair you see with Japanese yen is not always up to 4 decimal place. Let me show you here. Let me show you a Japanese yen pair here. See, look at this. AUD JPY. You can see the decimal place is just 3. 82.953. That's how Japanese. Sorry about that. That's how Japanese yen pairs go. So they are not always up to 4 decimal places. So there are brokers that quote currency pairs beyond the standard 4 and 2 decimal places to 5 and 3. They use 5 and 3. When I say 3, that's the yen pairs. They are quoting fractional pips, also called pipettes. So once it's more than 4, once it's 5 or 3, that is pipette. You call that one pipette. So if it's 4, the difference, you call it PEEP. So, and when you make profit or loss, we measure it in pips. We don't say I made $400, or so we measure our profit or loss in pips. So you can say, you just say I made 40 pips, because the same signal, different people will use different lots. So some people will use 0.001. When we get to lots, we'll discuss that. Some people will use standard lots. Some people will use different lots. So we now measure our performance in pips. That's the way we measure our performance. They are quoting fractional pips, also called pipettes. For instance, if GBP/USD moves from 1.51542 to 1.51543, that's just by 1. That's 0.00001. That's pipette, because it's now 5 decimal places. So USD move higher in 1 pipette. 1 pipette. Now let me show you something again. Look at this. Look at what this broker wrote. Spread 155. Now look at this. How many decimal places do we have here? We have 3. We have 5. 1, 2, 3, 4, 5. So the spread is now measured in pipette. So meaning this is 155 pipettes. Look at the second one, USD CHF. Spread is what? 40. I'm just using this as an example. It's not the main example. But it still goes. So meaning the spread is, for the first one, GBP CHF. The spread is 155. 155 pippets. If you want to measure it in pips, you say 15.5 pips. 15.5 pips. If you want to call it in pippets, you say 155 pips. For USD CHF, that's 40 pippets or 4 pips. For gold, okay, let's leave that. So that's it, all about pips and pippets. So if you are new to my channel, once again, make sure you subscribe. Make sure you like my video. Click the like button, hit the subscribe button, and click the notification button so that when I post the next lesson, which is lesson 5, you will be able to get the notification. See you in the next lesson.